legal, financial, and institutional perspective to bear on our topic today. Dan's background includes a run for governor of Illinois back in 2009. I think I remember one of his slogans was, "Illinois isn't broken, it's fixed."
It still is.
Over time, I've gained respect in general for the importance of understanding how law frames risk and return in finance, and that includes public finance as well as the financial markets more generally. Along those lines, we're happy to have Dan's perspective today as our guest moderator. Dan, it's good to see you again, quote unquote. The last time I really saw you, I think it was on the other side of a ping pong table. Do you remember that experience?
I do. Yeah, that was something. Pretty good ping pong player, almost as good as I am, as I recall that.
I'm not so sure.
Maybe I'm recalling that stylistically. I do understand. No, it's great to do this. It's great to pour through this report yet again. Another great work product of Truth in Accounting. And boy, there's so much to cover, particularly in this time of discussions of bailouts and relief packages and what $1.4 trillion in debt spread over the 50 states. So looking forward to hearing from you and Sheila and all the questions we have from those joining us.
Well, thanks again, Dan, for joining us. This is our 11th annual, believe it or not, we've been doing this for 11 years, financial state of the state. So we've continued to dig into states' financial reports, and we even have to go to their actuarial reports to get the true numbers because it's so hard to find government's information. We started this when we realized that governments were not reporting their true financial condition, i.e. they were required by governmental accounting standards rules to not put their pensions on the face of their balance sheets. So we realized that citizens and elected officials, nobody really knew the true financial condition of the government. So we went ahead and took it upon ourselves I initially thought it was impossible to do, to calculate the true financial condition of every state. This year's report, probably the most significant thing we found is that states were just not prepared for the current crisis. We found that states in total had accumulated more than $1.4 trillion of debt. All of this while they've been claiming their budgets have been balanced, because every state except for Vermont has a balanced budget requirement. We've also did a rough guess on how much the states are going to lose revenue during this time period. And we estimate that the states overall are going to lose $397 billion of revenue, Illinois losing $16 billion alone. We think that one of the major reason these states weren't in good financial shape going in is because while they were balancing their budgets, they were using accounting gimmicks to pretend that they were balancing their budget when they were going into debt at the same time. Illinois and our sinkhole states had balanced budgets, but we found that New York, for example, while they were balancing their budgets, has gone into $118 billion of debt. New Jersey, that number is $189 billion, Illinois, $226 billion, and California, who had, quote, a rainy day fund before the crisis happened of $23 billion, actually had debt of $275 billion. So for you viewers, if you want to see your individual state, you can go to our data-z.org website and look at your own state and also create charts to compare your states. Bill, did you have some comments about the report, your findings?
Apologize. Sure. In the next 5 minutes or so, I'm going to cover briefly the overview of the financial results that we saw in the 50 states. We'll look at some of the characteristics of good and bad states, and finally talk about the grades that we issue the states based on our taxpayer burden and how our analysis relates to the credit ratings that are issued and popularly covered in the media. First, on average, looking at the overall results, there was a modest improvement in the latest fiscal year compared to the previous year. However, modest is the important word there. It's from a bad position on average, looking at the 50 states, and especially in the troubled states. There's lots of variation out there too, though. We don't want to get too negative about the overall picture, because there are good actors out there, states like Utah, Tennessee, and Iowa, that really do truly balance their budget and retain fiscal balance. And we can learn from those states. But having said that, on average, the overall results were kind of unchanged from a bad position. It's also important to recognize that we're basing our analysis on the latest available data, but it's pretty much lagged data. We're talking about fiscal years for most of the states of June 2019, which is more than a year ago. That's what we're talking about. Unfortunately, that's the nature of the beast in studying our governments. They don't produce financial results on a timely basis. So last year we saw, again, some modest improvement on average, but more importantly, let's take a longer look since Sheila started doing this back in 2009. There's really been no significant change in the overall average financial condition for state governments in the 50 states. And that's significant given that 2009 was at in the middle of the worst economic and financial crisis since the Great Depression. We've had a pretty good tailwind from financial market and economic conditions since then, but the state governments haven't improved. And in some cases, they've only gotten worse. What this does help to highlight, though, is another valuable element of our data. Sheila had already put the pension and OPEB retiree healthcare liabilities on the balance sheets back in 2009, and we had a convulsion in the balance sheets reported to citizens beginning in 2015 when those numbers finally arrived. So what we have is a consistent time trend since 2009 that's worthy of looking at. Unfortunately, the news isn't that good. Looking briefly at Illinois, our home state, it was basically unchanged. But more fundamentally from that 2009 perspective, back then Illinois was already in bad shape. Its financial position was about 5 times as bad as the 50 state median. In the latest results, it was 10 times as bad. Illinois has gone backwards, not forwards, in a positive environment. Unfortunately, we don't have a tailwind right now. We're in the middle of a significant economic crisis caused in part by pandemic lockdowns. Briefly, let's look over some of the character when we study the states and use our Data Z website. Let's look at some of the characteristics that can distinguish good versus bad states. Good states you can learn from. States that, the states that are in bad shape tend to be older states. They tend to be relatively highly gerrymandered based on statistical techniques that measure gerrymandering. States that are in bad shape tend to be relatively highly regulated. One proxy for that is lawyers per capita. States with active lawyer and large lawyer populations tend to be in worse shape financially. And then 2 of the most important bullet points are down there at the bottom. Unionized states, states that are relatively heavily unionized, especially in the public sector, tend to be in bad shape. That's very curious in light of the fact that you would think that unionized states would be doing a good job of trying to make sure that the pensions were fully funded. That's the opposite is the case, especially in places like Illinois and New Jersey. And finally, our most important bullet point is down there at the bottom. States that actually do truly balance their budget according to walking the talk and having results meet the stated intentions in these budgets on an accrual basis. And we can talk about that later. Those are the ones that tend to be in good shape. The ones that don't do that, like Illinois, Connecticut, New Jersey, they're in bad shape. On the other hand, here's some consequences maybe of financial condition for state governments. States that are in better shape have had a better housing market recovery since 2009. They also tend, based on a few metrics, to provide better social services for poor people in their states. More fundamentally, in recent years, you see significant migration out of states in bad shape towards states in good shape. That's a challenge for the states that are in bad shape. And in the most recent Gallup poll, you can see a distinct correlation between our taxpayer burden and the ranking of the 50 states on trust in state government. In the latest result that I saw from Gallup on that score, Illinois came in dead last. And then I'm gonna have some brief thoughts here on our grades, we grade the 50 states from A to F as a way to simplify things further and provide an alternative to the widely publicized credit ratings. We're concerned that the media relies on credit ratings too closely for some good reasons. In our latest report card, we gave out 3 A's, but we also gave out 17 D's and 18 F's. And in fact, you can argue our rating scale is a little bit too charitable, given who we give a C to. And briefly, what are we going to look at in thinking about the credit ratings? Some of the feedback we got from the folks that didn't like our rating scale came from Delaware, and the folks in Delaware were saying, "How can Delaware be we've been AAA rated for 17 years. How can you give us an F?" And there are 6 good reasons why that we can do this. I think credit ratings are focused on the bonds. At Truth in Accounting, we care about the taxpayers and the citizens. Bonds are senior obligations that get paid first. Second, bonds are issued by, quote, sovereigns. I still recall a credit rating agency presentation a year or 2 ago where the people were talking about the fundamental strengths of the municipal bond market, including the fact that they're issued by sovereigns. Sovereigns can tax people. Well, the power to tax may be good for bonds, but it isn't necessarily good for taxpayers. Bonds in turn can also help kick the can down the road. The ability to borrow doesn't necessarily represent a source of overall financial strength. And then finally, credit ratings themselves may actually mask real deterioration that goes on behind the scenes, in part because the credit rating agencies are paid by issuers. And so that's just some introductory talk. And let's move now to Dan and see what he's got to say.
Well, why don't we move from your remarks, Bill, to some questions here. I mean, one, first of all, I want to audit this report to figure out how Illinois is 49th and not 50th, how bad New Jersey must be. So I don't know, I got a question there, but first we've got an attendee who's got a question about Iowa. Iowa is ranked in the top 10 with a grade of B, and the attendee would like some additional information on Iowa in terms of why and how specifically, I guess, quantifiable evidence about how well Iowa is doing fiscally.
Well, what we do when we analyze the states is we go to their audited financial statements and we look at the assets that they have available to pay their bills. We do a holistic approach. So in Iowa, we found that they have, not including their capital assets, they have $10 billion of assets available to pay bills. This would be cash, accounts receivable, and other things. And then we compare that to their bills. We found their bills were, I hate to say only when I'm talking billions of dollars, but their bills were only $8.7 billion. Their bills make up, $5.4 billion of bonds, about another $2 billion of other liabilities, and then they have unfunded pensions of $1.1 billion and retiree health care benefits of $447 million. So they have, so we calculate that they have $1.6 billion available to pay any future bills, and we divide that by the number of taxpayers, and that's $1,500. So we give the state a B. But you all have to keep in mind that this is all before the pandemic happened. So we believe that our rough estimate is Iowa is going to lose $3 billion of revenue during the crisis. So their financial position will most likely get worse as a result of this, unless Congress, does a huge bailout for the states.
Along these lines, Iowa, if you look in our Data Z website, we have a metric there called change in net position. And that's effectively the difference between all revenue minus all expenses on an accrual accounting basis. And every year since 2005, except for one, Iowa has kept its accrual revenue ahead of its actual expenses. In other words, they truly balanced their budget. They didn't just talk that they were balancing the budget, they walked the talk. And it's that type of behavior that we didn't see in Connecticut, Illinois, and New Jersey. The politicians tell us they balance their budget, but they effectively spend more money than they take in. And that's why we're at Truth in Accounting, we're working to have GASB adjust its accounting in the funds accounting.
So Bill, I want to follow up on something you said about Delaware. with respect to how bond rating agencies look at a state versus how Truth in Accounting does with the taxpayer in mind. And the difference in numbers as it pertains to Illinois, for example, Moody's is suggesting that Illinois has something like $420 billion in unfunded pension liabilities, where Truth in Accounting has that number, while substantial, more like 200 billion. I mean, these are huge numbers, but that's also a huge difference in those numbers. And so, can you explain that?
Yes, that's actually a reminder that in accounting, we see precise numbers on these financial statements, but behind the scenes, there are some ambiguities. In this case, it arrives because of a dispute over what the right discount rate is. In finance, we learn that a dollar today is worth more than a dollar tomorrow, and we discount future dollars. We do that for liabilities as well for bonds. Unfortunately, in the 50 states, government accounting standards have decreed that the states can use their expected investment rate of return, which more than a few economists and financial economists believe is not the right discount rate to use, but that's what they use. And they use a higher expected investment return than the risk-free interest rate. That's where Moody's goes, in a direction that may be the right direction. We take the numbers at face value. We don't adjust for the discount rate, but our numbers, as bleak as they are actually maybe a little too charitable, even compared to Moody's. And that's true for not just for Illinois, but all 50 states.
Sticking on Illinois, Juliet Fairley has a question. What grade was Illinois given, and why was it given its customary F grade?
Illinois, continues to go down the wrong path. They're reckless budgeting, even, just in the most recent budget, where they quote balance their budget by one, they're going to borrow $5 billion from the Federal Reserve. I don't know how you balance your budget by borrowing money. It doesn't make sense to me. And also they're counting on a bailout from Congress. Congress hasn't even passed a bailout, but they balance their budget assuming they're going to get revenue from the federal government. So we gave, Illinois an F. They have each taxpayer, in order to get the state into good financial shape, would have to send $52,000 down to Springfield in order for them to pay off their the pension debt they've already promised and incurred, the retiree healthcare debt they've promised and incurred, and the bonds that they've incurred. All again, while claiming they balanced their budget. They balanced their budget this year by borrowing money and hoping they get a bailout from the state, from the feds.
Well, speaking of bailouts, you had Senate President Don Harmon send a missive a couple of months ago petitioning the federal government for $42 billion for the state and local governments. Governor Pritzker suggesting maybe we could use on the order of $5 billion. When you look at this financial picture of Illinois, I mean, shouldn't they be shooting a lot higher if there is going to be any bailout whatsoever? I mean, what is $5 billion? What does even $42 billion get you if you're in this sort of position with $250 billion in obligations?
I'm sorry. This is where I've been harping on this for years, is that people, Illinois was claiming they were balancing their budget. Everybody, especially the people in DC, thought, oh, well, all the states must be doing fine. They're balancing their budgets. Meanwhile, they were going into debt because they were playing these accounting shenanigans. And we believe we don't take the position on whether Congress should or shouldn't give another bailout to the states. But if they do, let's set some conditions. Let's require the states to truly balance their budget. Let's require them to truly fund their pensions. Most of the states do pay as you go for their retiree healthcare liabilities. Those need to be pre-funded. And so if Congress is going to provide an additional bailout, let's set some criteria for it. Let's not give them, just give them money without some conditions. And also in the amount, you know, people are throwing them out, well, we should give them 500 billion, we should give them $1 trillion, let's go ahead and base that on actuals. We do have audited financial statements for 2019 for all the states, except for California doesn't have theirs done. If you're gonna give the states money, let's make it based on, okay, here's how much revenue the state got in 2019 according to their audited financial statements. Here how much revenue they're getting now, and give, you know, either 100% or 5% of that as the quote bailout, not just throw money at them using a random number, because nobody knows. Even our guesstimate of $397 billion, nobody really knows how much the states and local governments are going to lose, because nobody's been in the current situation we're in.
And so far, the dollar amount that's been quote lost unquote is far below what the federal government has already provided. It's possible there will be a lag on that score, and the estimates that are out there, including ours, depend on the next year or so, not just current losses, but to date, the dollar amount of federal money that's been given to the states is actually, the states have come out ahead so far, not behind. And that's why maybe it underscores the importance of basing any future aid, if you even believe that's appropriate, on the basis of actual tax losses, not the quote unquote projected ones.
Just sticking on Illinois for a second, a local question, Jim Cranch. I noticed that DuPage County announced that it has a balanced budget and has been balanced for the last 10 years. Does Truth in Accounting analyze county level financial data as well?
We do. 4 years ago, I believe, maybe 5, we started doing the 75 most populated cities. And we do special analysis of other governments. But what we find is that most governments, and you know, DuPage County could be the same way, they balance on what us accountants call the cash basis. It's the checkbook basis. So they figure out, here's how much money we think we're going to get into our accounts, and here's how much money we're going to spend. And that then we determine whether the budget's balanced or not. Well, how much money you get into the account could include money that you borrow. It's not just your earned revenue. And then also the county could not be including some of its expenses. And the major expense that we find that the governments do not include is all of their compensation costs. So compensation costs, if it's a paycheck, that's included in the balanced budget calculation. But if it's deferred compensation, like a pension or a retiree healthcare benefit, only how much the government chooses to put into the pension plans or the retiree healthcare plan is calculated in the budget. So we find that usually governments underestimate their compensation costs. They don't fund their pensions properly, and therefore costs are pushed onto future taxpayers, and they are really not balancing their budgets.
Along those lines, I still recall, it wasn't in DuPage County, but the city of Chicago. I had a chat with a member of the finance committee in the Chicago City Council, one of Alderman Burke's colleagues, and I asked him, you know, how can you claim to balance the budget when your revenue falls short of your accrual expenses every year? And he almost said it as a matter of pride. He said, well, we borrow money in order to, you know, to balance the budget. It's as if, you know, running up the credit card is a source of strength.
Right, and you just go to the right, you just go borrow to shore up the gaps. And I think, Sheila, essentially you were speaking to this question from Barrett Peterson. Is the problem not in part the budget is required to be on a cash basis rather than an accrual basis? And I don't know if you want to add anything to your previous remarks.
Oh yeah, definitely. What people don't understand is budgets are not, there's no like, here's what you need to do to calculate your budget. We call it political math. They can pretty much include whatever revenue they want to include and exclude whatever expenses they want to include. I call it the wild, wild west of budgeting. Then there's the audited financial statements. And unfortunately, the general fund, which is the largest budgeted fund, in the financial statements is also calculated on the cash basis. So a user of their audited financial statement can't go to the audited financial statements and say, was my budget truly balanced or not? Because the current way they do their financial statements, the general fund is calculated in the financial report just like it's done the budget. and both of them are wrong. So we are pushing the Governmental Accounting Standards Board, which nobody's heard of. Corporations have to follow standards, all the same standards done by the Financial Accounting Standards Board. But the governments were like, oh, well, we don't want to, we can't live by those same rules. We're going to set up our own board. So they set up their Governmental Accounting Standards Board. And this board is letting governments do their financial reports on the cash basis for their general fund. So right now we're pushing that board to change that so that they are done on a full accrual business, just like businesses have to do, and calculate their budgets, their financial report for their general fund using good accounting instead of the bad accounting they're doing now.
Along these lines, in light of Barrett's question, Sheila and I sometimes look at each other and wonder how, in the media and in the public conversation, budgets get a lot of play. But when the financial reports come out, the audited financial reports, you don't see much of any discussion and/or until relatively recently. And I suspect one of the problems is that budgets, people care more about spending money and getting it as opposed to accounting for it. And it's those budgets that are get so much attention, but they're not on the same basis as the overall financial statements. And if we'd been paying more attention to those overall results, not the budgets, we'd be in better shape today.
Yeah, and we're lucky now because we did pressure us and others pressured the Governmental Accounting Standards Board to put their pension and retiree healthcare liabilities on the face of their balance sheets. So they are doing that now at a consolidated basis, but they're still not doing that at a fund level, at the general fund level, which again is where these balanced budget calculations are done. So just like we pressured GASB to change the standards for pensions and retirees, we're working to get them to change the standards so the general fund is accounted for properly. And everybody who's listening has an opportunity to join us in this effort. They just need to send a simple email to GASB saying, hey, we want the correct numbers. And we'll work with you on what that email should say. Just reach out to us and we'll be happy to work with you on that.
Well, and also the issue too, just of media financial literacy in terms of why only spending the budget is covered as opposed to the financial reports and the balance sheet. And so Truth in Accounting's work product is helping to perhaps provide a crash course in a little bit of financial literacy for members.
Yeah, and we found it interesting. We have two. Illinois always gives us great examples of bad situations. We have two examples in Illinois where this bad accounting showed up. One for the fiscal year 2018 and 2019, the Illinois comptroller issued a press release and highlighted that the state's deficit had cut in half. That they'd actually run a surplus that year. But if you look at the audited financial statements and you look at the general fund, well, she was able to say that because of the bad accounting, which there's a line there that says loan proceeds, $6 billion. Right. And the other one was CPS, where in early 2019, right before contract negotiations, the audited financial statements came out, and they said that they had $342 million available. They went to contract negotiations. The labor union said, well, obviously we have more money, more resources. That should get into the classroom. Well, that $342 million did not include the billions of dollars that they owe to the pension retiree healthcare funds. So they really did not have extra money to spend, but the unions were still able to get a $1.5 billion contract over 5 years because of the bad accounting.
And speaking to Dan's comments about the media along those lines, after that CAFR came out, the Comprehensive Annual Financial Report for the Chicago Public Schools, one local newspaper had an article about how Chicago Public Schools and the Chicago Teachers Union were going into the negotiating year in a position of strength. The CTU was in a position of strength because of this surplus that was but they chose to focus on that governmental fund, not the bottom line in the statement of net position. So that's just underlines Dan's point about the media.
Yeah, they keep two sets of books, the consolidated books that they don't use that showed a deficit versus the general fund statement that showed a surplus because of this bad accounting.
I mean, the lack of curiosity is remarkable. So for all of these years, it was a financial catastrophe, the Chicago public school system. But then all of a sudden, they have a surplus out of nowhere. That may prompt a little intellectual curiosity among those who are curious. But we talked so much about the bad examples. So we've got a question about the good example, according to this report. That would be Alaska. Alexandra Fall. Could you discuss how Alaska ended up being your top ranked state? All the financial news around that state seems to indicate they aren't in good shape.
Yeah, we do a holistic approach. So we include the assets that are available to pay future bills along with their debt. A lot of studies do have Alaska as the worst state. Our study has, because as one of the worst states, because their pensions are not funded well. But Alaska does have some permanent funds that they have available that they could use to pay down their pension debt and their retiree healthcare debt. Now in Alaska, there's actually two permanent funds, one that is untouchable by law, and we do not include that in our analysis. It's a restricted assets, and just like all the other states, we take restricted assets out of our calculations. But they do have what they call a budget stabilization fund that they could use to balance their budget, take money out of that fund and balance their budget. As you say, up there in Alaska, they're fighting, right now, as all the other states are, because their current revenue is short what they expected. But the people in Alaska, they don't want money even coming out of this budget stabilization fund.
And so, I mean, it sort of underscores an important point that the report is about wherewithal. It's not necessarily about the policy choices you should or shouldn't make that you did or didn't make.
Right. And and again, the people in Alaska, they are choosing not to use their savings. They would rather, cut spending, or maybe probably not raise taxes. Most taxpayers don't like that, but they're looking at ways to cut. In Illinois, when they quote balance their budget, they didn't look at ways to cut. They're just like, oh, well, we'll use the same accounting shenanigans we've used in the past. We won't fund our pensions properly. We'll borrow money. We'll pretend we're getting money from the feds. Up there in Alaska, they're having a grand debate because they really want to truly balance their budget, not use accounting gimmicks like that.
Let's put a pin in another state. Matt Trotter asking about Oklahoma. You've projected Oklahoma will lose $4 billion in revenue as a result of the pandemic/economic crisis. What period of time is that over? Where do you project those losses coming from?
I'm hoping Bill can answer that one.
Well, sure. I guess the overall framework we used, and again, we're going through this process, was excruciating when you realize how hard it is to understand the factors that would impact future economic and financial conditions in the current crisis. However, the way we did it in general, and then I'll talk a little bit about Oklahoma, we looked at the latest and greatest financial crisis back in 2008, 2009, and came up with an assessment of how sensitive state government tax revenues from a variety of sources were in the downturn, and it came up with an econometric equation that tried to make a prediction for what would happen if it was just as bad as that last one. And the period of time that we're talking about is about a year and a half up until the fiscal year ended 2022, and in that time frame, that it would come from traditional the tax revenues for Oklahoma, which the important ones there are for the income tax and sales tax. Having said that, it's important to step back and again caution that these are only baby projections, not the truth, and we're careful about that.
Yeah, again, we're in this pandemic that is unprecedented. And it's hard for us and everybody else. I would caution anybody looking at any estimates of what states are going to lose or local governments are going to lose. to be very careful. These are just very, what I actually came up with the term, they're slugs. They're sloppy, logically uneducated guesses. We did the best we can based on the pandemic, looking at the unemployment rate and how that affected the state's revenues, and then how long the previous recession lasted, and who knows if this recession is going to last that long, and came up with a slug, a guess.
The Oklahoma angle there is worth considering in light of the Alaska question just previously. Another thing that makes this crisis different from the last one, Oklahoma, Texas, North Dakota, Alaska, Wyoming, they all tend to be in better shape. And I would argue that maybe Texas isn't as good shape as it should be, given the tailwind from oil prices until recent years. And Oklahoma and Texas have different challenges today than they did back in 2009. So again, it's, the future isn't always the same as the past, and yet we have to use the past to try to predict the future, and with a cautionary note that you've got to be careful out there in forecasting land.
Well, and the other complicating factor is that the reality changes on a daily basis in terms of different states pursuing different policies in response to the pandemic, and that's unknowable, based on caseloads and other measurements that states are using to make public policy decisions in this vein. So that makes perfect sense. I wanted to get another question in about another state. The grade California was given, and why, and how that compares to Illinois as competition for the bottom there.
Well, California is a very unique situation this year. California, the numbers that we used is for the latest financial information available. So that would be for most states, it's June 30, 2019, obviously well before the pandemic. For California, we had to use June 30, 2018 numbers because their financial report isn't out yet. Other states and local governments have been able to issue their financial statements during this pandemic, but California, we don't know where it is. They don't anticipate it. California is also unique in that before going into the pandemic, California had a theoretical rainy day fund of more than $23 billion. So they theoretically, everybody in the state thought, oh, they must be doing great. They're balancing their budget. We actually have extra money available. But the latest numbers available showed that California owed $275 billion. They were in debt by that much money. So a rainy day fund, which other states also have, is kind of like Dan, me saying, hey, look, I got $23,000 in my savings account, but ignore that I have $275,000 of credit card debt. So these rainy day funds just, don't make sense in California. Hello, where's your financial statements? We believe, it would be good for the citizens and the elected officials, especially before you went and did your budget, which I assume they've already passed. Wouldn't it be good to know how your last year's financial, what happened last year, to get your credit card statement before you start making future plans?
Just a question about the rankings, because I think people read a lot of different rankings about the states and who's best managed and who's most attractive to business and so on and so forth. And you sort of have to look at the details to understand how the measurements are being made. And so you see, I saw, Mercatus Center does a ranking of the states on fiscal health, and Forbes does one on essentially business friendliness, and Steve Moore and Art Laffer do a rich states, poor states. And maybe just a restatement of the methodology here so people can distinguish how the state's fiscal health is being measured when it comes to the financial state of the state's report from TIA versus some of these other rankings that they'll see.
Well, there are a variety of different ways to measure states. It's important to distinguish between, are you measuring the state environment or are you measuring the state government? And in turn, when you're measuring state governments and comparing them, are you measuring the governmental quality, and what goes into that? What we're focused on is very strictly focused on the financial position as indicated by the balance sheet. We're focused on the what's left over, the residual claim in financial markets for companies and corporations. The shareholder gets what's left over, and the analysts are trying to understand how valuable the overall enterprise is, all the debts of the firm, and then in turn, what are the what's left over for the shareholder. That's what a balance sheet is in corporate finance, and that's what we're focused on. What's left over. The bonds are above the what's left over, and the what's left over for governments is for citizens. And if it's negative, it's for the taxpayers that have to make up the other short end of the stick. Having said that, our numbers tend to do a good job of aligning with some of these other metrics of state competitiveness, for instance, and state, the ALEC rankings on, looking forward, who has the best economic outlook. And as a general rule, it's the states with lower levels of government activity in the overall economy, as well as lower unionization, less regulation, the ones that those folks believe provide higher prospects for future economic growth. They also tend to be associated with the states that are in better financial position, as opposed to what we have here in Illinois.
And
Yeah.
if I could, following on that, Bear Peterson asking, do tax rate structures, portion of sales versus income, tourist driven versus property, does that correlate with state rankings as well? Or is that
Yeah,
sort of
so that does not correlate with we don't include that in our rankings. To get, since I'm an accountant, I have to get, into the numbers. People can go to our data-z.org website and pull up their individual states report. It's a PDF that you could print, but you can look at it there. And I'm looking at Illinois. So what we do is we look at their audited financial statements on a consolidated basis, which are done, now that we have the pension and retiree healthcare liabilities on there, they're done on a pretty good basis. We take the assets that they have on there. We take out the capital assets, because it's kind of like, we don't want you to sell your house in order to pay off your credit card debt. So we don't want the state selling bridges or skyways to pay for their debt. We take off the restricted assets, like we talked with Alaska, how they have some funds that they have restricted by law or contract, and calculate the number available to pay your bills. In case of Illinois, that's $28.5 billion of cash available to pay their bills. Then we subtract their bills, the bonds that they have, any other debt. We do take off the capital debt, because it would be unfair to take off the asset side, but not the liability side. Then we add up the pensions and the retiree healthcare debt, come up with Illinois' total debt of $254 billion, subtract that from the $28.5 billion of assets available to come up with $226 billion of money needed to pay your bills. Divide that by the number of taxpayers to come up with $52,000 per taxpayer. Any state that has a taxpayer burden of higher than $20,000, we give an F to, so Illinois received an F.
Question from Charles Chokel. Can you explain why total state shortages improved from 1.5 trillion in 2018 to 1.4 trillion in 2019, $100 billion improvement, even though total pension shortages were 31 billion worse, while total retiree healthcare promises were 48 billion better?
Well, that would be, in relation to, again, this is before the pandemic, so the economy was running well. So states either got additional revenue, or one thing that, we're calculating the unfunded pension liabilities. So this is the assets minus the liabilities. The assets were in the market. The markets were doing well at that time. So they actually had more assets versus, the liabilities. So that would account for the betterment. Also, we did notice that in some states, a few states, their actuarial assumptions changed, especially in relation to retiree healthcare benefits. They used a higher discount rate to calculate their unfunded pension retiree healthcare liabilities. So that improves some states. So that's the overall improvements.
This is a really good question. Perhaps something to take under advisement if it's not already being done. Do you take into account the ability to raise future revenues? In other words, the amount of wealth that's leaving or entering a particular state? What's the landscape that policymakers have at their disposal that are operating on? That's a good question.
Yeah, that is a great question. We look at just the balance sheet at one point in time, like most accountants do. We don't look into the future and here's how much they can get. Here's how the revenue. I know that the rating agencies consider that, and there are other metrics in relation to that. We don't look at that. One thing we did find when we first started doing this is other people, they say, well, you're not looking at GDP and you're not looking at median income there and you're ranking these states poorly. We're like, well, our study's big enough. I don't think you want all those statistics in it also. What we did is we tried to find a database that had all those numbers, and we couldn't find one. So we created our own. That's what our data-z is. You can go there. You can look at, you can go to the tab that says create your chart. You can create a state chart, and we have more than 700 data points where you could look at other data like that to compare your state and other states to each other.
Along those lines, corporations aren't allowed to capitalize future expected sales revenue in their assets, and we don't think states should be able to capitalize future expected tax revenue, in part because the taxpayers, and we're seeing in recent years accelerated departure from the states that are raising their tax rates, and so you shouldn't be allowed to count on the future taxes as your current financial position.
Question from Don Nemerov. Here's the operative question in Illinois. How to fix Illinois? This has been going on for decades. I may suggest one interesting proposal just out this week from wirepoints.org. Mark Glenn and Ted Dabrowski over at Wirepoints talking about how you can shave tens of billions of dollars in unfunded liabilities off of Illinois state unfunded pension liabilities by moving people to a pension option that actually tens of thousands of state university retirement system employees chose right now, which is to take it out of the hands of the politicians and manage it themselves. That moves it from a defined benefit to a defined contribution plan, likely necessitates a constitutional change, but it is something out there. I mean, I don't know about you, Sheila and Bill, but this is always the operative question, and certainly people understand it because it has been going on for decades. But it's always been a matter of political will, not a matter of good ideas or an understanding of accounting principles among professionals.
Yeah, and I think that that question is, as you say, is a great one, and it is that when we started this, people didn't understand this. They thought their budgets were balanced. Now Illinois is in such bad shape that they have to understand it. And we say in our position, we're a nonprofit, nonpartisan organization. We don't, give you solutions, tax or spending policies. We do want the accounting done better. We want that. We want to change those policies. But I say overall, we have a cash shortfall problem. And in order to fix that, you need to either raise taxes or cut spending. And in this case, we're going to have to do a combination of the two. So, but the legislators have, in the past should have already been making those decisions. If they didn't continue to pretend they were balancing their budgets, in the past, they would have had to raise taxes and cut spending. So we think that, they really haven't allowed the citizenry to be a part of this process because we really didn't know how bad shape we were because they were pretending they were balancing their budgets when they weren't.
And in turn, going forward, we would, we step back on policy except for accounting policy, and that underlines our enthusiasm. And hopefully we can get readers and citizens and listeners today interested in this financial reporting model initiative at the Governmental Accounting Standards Board. We believe that there's a better direction that they could be moving, and that's towards more accrual-based accounting for the governmental funds accounts. That's a start towards fixing the problem.
And attaching attaching criminal penalties, I should say, to a failure, because that's about what would be required. But
well, that's what corporations would have.
Right.
And
Right.
corporations also have to follow ERISA, which was in the 19th. You don't hear as much about private pension plans being in trouble, and that's because they have to follow ERISA, most of them, which was in the 70s, because they noticed that these corporations were having financial difficulties. Some of them were going bankrupt and there wasn't money available to pay these people's pensions that they were counting on for years. Unfortunately, there was one line put in ERISA that exempts state and local governments. Maybe we should, maybe that should be a condition for additional federal aid, is that you have to follow ERISA. That would require them to report their pensions more accurately. They would have to use more reasonable discount rates. And also they would be required to properly fund their pensions. Right now, if a legislature, especially during this pandemic, if they have financial trouble, it's like, well, if I raise taxes, the voters are going to be unhappy with me. And if I cut spending, the voters are going to be unhappy with me. But, well, if I just don't put enough money into the pension plans, most people don't pay attention to that. They don't understand it anyway. So they have just woefully underfunded these. Under ERISA, if the state and local governments had to follow that, they would have to, by federal law, fund their pensions and retiree healthcare benefits properly. And if their systems were in trouble, they would have to come up with a plan to fix them as soon as they got in trouble, even a little bit of trouble. If they were a corporation, if you're underfunded by 80%, you have to come up with a plan on how you're going to fix that. And if they go below, I think 60%, they have to follow that plan. Well, governments, they can fund whatever they want to. They can use whatever discount rates they want to. Let's get the state and local governments under ERISA.
The other potential attractive feature of moving to an ERISA-like federal framework is that provides an arena that overrides the state laws that restrict the ability to change retirement benefits. There's some debate about that, but that's another possible added benefit of moving to that federal type solution.
I wanted to go back to something you said earlier, Bill, when we were talking about the various states, and you said that some people in Delaware weren't happy with the calculations that Truth in Accounting did. The impact that Truth in Accounting is having by telling the truth about states' accounting, and cities for that matter too, when you do reports on cities. If you could just delve into that a bit, Sheila, as well.
I guess, sure. I guess that's a sign of progress when we're seeing pushback like that. We feel confident in our arguments and the integrity of our framework. And when we hear that type of pushback, it's possible we're stepping on the right toes to step on.
Yeah, and also, again, we did push for years to get the pension and retiree healthcare liabilities on the face of the government's balance sheets. Governments pushed back hard, said it was impossible to calculate those amounts, but we continued the fight and did get those numbers on the balance sheet. So we calculate money needed to pay bills. If we haven't done, like DuPage County, we haven't done an analysis for them. Since the numbers on their balance sheet they're pretty accurate now, citizens can go to their audited financial statement, look up their statement of net position, and look for a line called unrestricted net position. It's the unrestricted number. If that's a negative number, that means those are the amount of bills that your government has incurred and pushed on to future taxpayers.
And I wanted to go back to something else raised when we're talking about borrowing and the rating agencies and the rating agencies' priorities versus Truth in Accounting's priority, again, being the taxpayer. How much of a good or bad actor, how much of a conspirator are the rating agencies when it comes to states and local governments piling up the kind of debt that's documented here?
I guess very simply, they've been part of the problem. Sheila has a desire to write a book about complicit or complacent or conspiracy. And I'm afraid the powers that be, the network of special interest groups that benefit from this process, the ways in which the bond industry benefits from continual borrowing as a source of revenue, and they make money on the bonding process. The credit rating agencies are paid by the issuers of the securities. They have a vested interest in placating the governments and giving them the answers that they want. We learned that in the financial crisis in 2008, 2009 in spades. And the fact that the federal government and its regulations is still enshrining credit ratings in financial regulations, despite the fact that Dodd-Frank directed them to stop doing it, is a sign of how entrenched the credit rating agencies are in the overall process. And here we are, for instance, in Illinois, where Illinois is granted quota, borderline cusp junk credit, except for the fact that the actual interest rates being paid by Illinois on the bonds in Illinois are much more suggestive of a real junk credit. That's a sign that the credit rating agencies are politically driven not to tell the truth, but to tell what's necessary for a junk versus an investment grade credit. I'm afraid we should all be standing up and taking care of our own pocketbooks, and the credit rating agencies are part of the problem.
Yeah, and we do find that when we go, especially to smaller governments, we go and we do our analysis. They say, whoa, we have, we're in fine financial shape. We have a good credit rating. And also, Bill could talk more. He's a big fan of The Big Short, where the housing market. Right. A lot of those bonds were also the credit rating agencies gave good ratings to.
There's a wonderful paper from 1999 by Frank Partnoy, a law review article titled "The Siskel and Ebert of Financial Markets, Two Thumbs Down for the Credit Rating Agencies." Frank Partnoy is a professor of law at University of California. His argument was that the rating agencies gain a lot of their credibility simply because the regulators force people to use the ratings in the regulations. And when they do, the regulations enshrine the credit rating in a way that incentivizes issuers to give money and more money for ratings that meet regulations. And so the ratings really aren't that meaningful. They matter for the bondholders, but they can be deceptive for citizens and taxpayers.
And then you have, in addition to that, in this time of COVID-19, you've got the municipal facility that the Fed set up to perhaps do through the back door what they're not going to get through the front door, meaning states and cities, if they're not going to get a formal bailout in grant form, they can borrow via the municipal facility the Fed set up, as Illinois has already done.
Oh, Bill can really talk to you about that.
Unfortunately, we don't have enough time to address that issue. However, that's a matter of, I believe, future investigation by congressional oversight committees, whether or not Illinois should have had the access that it already has had. And Illinois Governor J.B. Pritzker's certification that Illinois was not insolvent as required by the law is a suspect certification, a longer story.
And also, I think you're getting this facility is kind of taking away state power and state taxpayers' power because, they have balanced budget requirements for a reason, and some of they have been limited because because of the bond market. Well, now they have another federal facility that they can use to borrow money. It's not like the Federal Reserve is giving them money. It is borrowed and future taxpayers are going to have to pay for it.
I mean, this just speaks to this conversation we're having essentially about what are the mechanisms to incentivize discipline or impose discipline. And so perhaps our last question from Bear Peterson, do we need more pressure to advance laws governing accounting that's required to be used for budgeting, requiring accrual, not cash flow accounting? The GASB still needs work, as you were both saying earlier.
Yeah, definitely. And that's where we could use, Barrett's help and all the viewers' help to pressure GASB to get the general fund accounted for on an accrual basis instead of the cash basis that they currently do. And people just contact us. You can join us. It's just a simple email that you need to write. These rules need to be changed. And if we can get the accounting rules changed, at least we can point to them and say, well, yeah, you said you balanced your budget, but you really didn't. And here it is in your audited financial statements.
All right, I'll leave it to Sheila and or Bill for some Jerry Springer final thoughts.
Well, again, thanks everybody for coming. Thank you, Dan, for being our guest moderator. We enjoyed having you. And again, the Financial State of the States is out. Go to our data-z.org website, look at your individual state, create your own charts. Bill issues a morning call where he summarizes the federal, state, and local government accounting and budgeting stories. You can get that. That will also announce when we issue our financial state of the city. So appreciate everybody joining us. Thank you, Bill. Thank you, Dan. And thank you to our listeners.